Diane, do you think there's going to be a data set that ends up being more convincing to either the Hawks or the Doves than we've gotten so far?
Not before the meeting in September, which is why they're willing to stand on the sidelines. I actually think they probably will skip November, and this is the peak in rates. But the higher for longer message really came through. I was at Jackson Hole with Steve, and there really is a commitment to higher for longer. And that's because the math gets really hard from here, and they know it. Unless we see an absolute flatlining of inflation on core inflation from here through the end of the year, you're not going to get anywhere near the Fed's 2% target. That means the Fed needs to hold rates higher for longer, and you're hearing that from central banks around the world. Now, Christine Lagarde is more concerned about a wage price spiral, even as their economy slips into a technical recession in the Eurozone led by Germany. We're not as worried about that here, but the bottom line is the job is not done, and that message was clear. And I think the other side of this is that the Fed doesn't expect to cut rates as rapidly as it hiked rates, nor does it expect to go to the ultra-low rates that we saw in the wake of 2008-2009 recession. The balance sheet repairs that we saw in the wake of that Great Recession have really helped us to be much more resilient this time around, but it also justifies higher rates than we had prior to the crisis.
But Diane, on the other side of the equation, the economic data is starting to come in a little bit soft, and people are paying attention to, for instance, what we heard from some of the retailers, Macy's and Nordstrom, rising about increased rate of delinquencies from credit card borrowers, that sort of thing. Isn't the flip side that if the economy weakens more materially and we start to see the stress show up, as we do with lags from central bank, hiking of 525 basis points, then they will cut earlier than expected?
Well, you'd need to see quite a substantial weakening from here. And let's face it, the current quarter is still adding up to well over 3.5%, looks like 3.8% in the current quarter. That's stunning economic growth and an acceleration over the summer. July was the strongest retail sales and overall consumer spending we had since we got that record bump in Social Security payments in January of this year. So I think those issues are really important, that we're seeing a rotation in spending away from some areas into services. But services is where the Fed Chairman Jay Powell spent a lot of time on saying we're worried about that being more labor intensive, more resistant to rate hikes, and that's why they want to do higher for longer. So I think the economy is showing remarkable resilience. We've even seen on the Treasury data that people are starting to pay back their student loans in August ahead of October. That's good news because it means they can afford to, but it will slow down growth. I don't think we're going to see an actual recession. If we did see a recession, that is what would cause the Fed to lower rates sooner. But again, you really have to have something deep. A mild increase in the unemployment rate is within what the Fed considers a soft, or as Jay Powell has often put it, soft-ish economic landing.
Yeah. Finally, speaking of August, when things were really getting dicey, Daryl, some technicians were saying, we consolidate to maybe 4,300. Do you think that might be a little generous short term?
I think, as I mentioned before, we're stuck between 4,300 and 4,600. We tested here in mid-August the 4,325, which was actually the August 22 high for the market, right, which was a good support level. We bounced off of it, came back to around 4,500. We still think, though, that the preponderance of evidence, the 20-day pierced through the 50-day, right? You still got a 200-day that's challenged on the S&P 500. So we wouldn't get aggressive here until probably 4,100, 4,200. Remember, on any given calendar year, you typically have 3 7 to 10% corrections. We've had 1 so far this year. It happened in February and March. It was 9% peak to trough. We're due for another one. And I think Diane's right. The key here about recession or no recession is the consumer and labor, right? And remember, labor starts to deteriorate about 23 months after the Fed starts its hiking cycle. We're 19 months in now, so it's right on cue where it should be.
Wow. We'll watch some of those numbers. It's great to have both of you guys. Good to see you. Thank you, Daryl and Diane.